With India's logistics costs remarkably dropping below 9% of gross domestic product, has it officially emerged as the most formidable rival, threatening Vietnam's foreign direct investment appeal? In the landscape of the 2026 high-tech boom and the China Plus One strategy, operating expenses or Opex serve as the decisive weapon for nations vying to attract global technology giants. Let us break down and compare in detail the Opex landscape between Vietnam, Thailand, Indonesia, and India. First, let us examine foundational costs, labor and energy. Vietnam maintains its status as the regional leader in labor cost competitiveness, ranging from 0.85 to 1.2 United States dollars per hour. However, since the start of 2026, regional minimum wage hikes and new social insurance regulations have placed notable pressure on labor-intensive sectors. Meanwhile, Thailand presents the highest costs at 1.6 to 2 United States dollars per hour, yet it offers superior technical proficiency and productivity. Regarding energy, Vietnam and Indonesia remain the primary focal points. Vietnam's industrial electricity rates are highly attractive, ranging between 0.087 and 0.095 United States dollars per kilowatt hour. However, stability risks persist during summer peaks. Indonesia holds a slight advantage, utilizing domestic coal and gas resources to subsidize energy costs down to 0.07 to 0.1 United States dollars per kilowatt hour. Second, we address logistics efficiency, Vietnam's most significant bottleneck. Despite rapid expressway expansion, logistics costs in Vietnam still comprise 16 to 18% of gross domestic product, due to a lack of synchronization between seaports and logistics systems. In contrast, India has made an astonishing leap forward. Through the multi-billion-dollar PM Gati Shakti initiative, India has optimized its infrastructure, slashing logistics costs to a single-digit level of 8 to 9% of gross domestic product. Thailand also maintains a stable cost ratio of 13.5%. Third, the battle for land, taxation, and incentives. Regarding production facilities, India is significantly undercutting the region, with industrial land lease prices from 80 to 150 United States dollars per square meter, which is considerably lower than the 150 to 210 United States dollar range in Vietnam. On tax policy for 2026, while India offers a highly preferential 15% rate, combined with the production-linked incentive program for semiconductors, Vietnam maintains a standard corporate tax of 20%. Notably, to mitigate the impact of the global minimum tax, Vietnam has strategically activated an investment support fund to stabilize long-term cash flow for multinational corporations as a modern alternative to traditional tax incentives. Where then lies the optimal choice? Despite mounting pressures, Vietnam remains the sweet spot for balanced costs, particularly for investors leveraging coastal economic zones. Ultimately, if labor and energy are the primary priorities, Vietnam and Indonesia lead the way. For those seeking a robust ecosystem and high-tier skills, Thailand is the choice. And for those requiring immense scale, India is the destination. A critical note for foreign direct investment enterprises in Vietnam for 2026: accelerate digital transformation and consider on-site renewable energy, such as rooftop solar, to hedge against forecasted electricity price increases later this year.